Hey everyone, welcome back to Growing Mindset, where we uncover the truth about money and how you can take control of your financial future. Today, we're diving into a topic that many people think they understand, but don't fully grasp: the 401k. If you're relying on your 401k to secure your retirement, this video is a must-watch. We'll expose the common pitfalls, hidden fees, and mistakes that could derail your financial plans. Stick around till the end because we'll also share actionable tips to help you maximize your 401k and avoid these nightmares. Let's get started. Section 1. What is a 401k and why is it important? Let's start with the basics. A 401k is a retirement savings plan offered by employers to help you save for the future. Contributions are made pre-tax, meaning you don't pay taxes on the money you invest until you withdraw it. Many employers also offer a matching contribution, essentially free money to help you grow your retirement savings. Why it's popular: tax benefits. Contributions reduce your taxable income. Automatic savings. Money is deducted directly from your paycheck. Employer match. Boosts your savings effortlessly. However, the 401k isn't perfect, and if you're not careful, it can turn into a financial nightmare. Section 2. Nightmare number 1. High fees. One of the biggest problems with 401k plans is the hidden fees. Many people don't realize that the fees associated with their 401k can significantly eat into their returns over time. Types of fees. Administrative fees, charged by the company managing your 401k. Investment fees, associated with the mutual funds or ETFs in your plan. Advisory fees, charged if you're using a financial advisor. Example: if your 401k has an annual fee of 1% and you're saving $500,000, you're losing $5,000 a year, money that could have been growing your retirement fund. Check your 401k statement for a fee breakdown. If the fees are high, consider rolling over your 401k to an IRA with lower-cost investment options. Section 3. Nightmare number 2. Limited investment options. Another issue with 401k plans is the limited choice of investments. Most plans only offer a small selection of mutual funds, which may not align with your financial goals or risk tolerance. Why it's a problem: lack of diversity limits your ability to spread risk. Subpar performance. Some funds may underperform compared to the market. What you can do: choose low-cost index funds if available. Consider opening a separate investment account to diversify outside of your 401k. Section 4. Nightmare number 3. Taxes in retirement. Many people focus on the tax benefits of a 401k during their working years, but forget about the tax implications in retirement. When you withdraw money from your 401k, it's taxed as ordinary income. The reality: if you're in a higher tax bracket in retirement, you could end up paying more taxes than you saved initially. Required minimum distributions, RMDs, force you to withdraw money starting at age 73, whether you need it or not. Solution: consider a Roth 401k if your employer offers it. Contributions are taxed up front, but withdrawals are tax-free in retirement. Diversify your retirement savings with tax-advantaged accounts like a Roth IRA or Health Savings Account, HSA. Section 5. Nightmare number 4. Borrowing from your 401k. Borrowing from your 401k may seem like an easy way to get cash for emergencies, but it comes with serious risks. The problems: double taxation. You'll pay taxes on the loan repayments and again when you withdraw the money in retirement. Lost growth. The money you borrow stops growing, delaying your retirement goals. Example: if you borrow $10,000 from your 401k, you could miss out on tens of thousands of dollars in potential growth over the next 20 years. Actionable tip: avoid borrowing from your 401k unless it's an absolute emergency. Build an emergency fund to cover unexpected expenses instead. Section 6. Nightmare number 5. Over-reliance on your 401k. Many people think their 401k will be enough to cover their retirement expenses, but that's rarely the case. Why it's risky: rising healthcare costs and inflation can erode your savings. Social Security benefits may not be enough to fill the gap. Solution: save in multiple accounts. Combine your 401k with IRAs, brokerage accounts, and HSAs. Calculate your retirement needs and adjust your savings rate accordingly. Section 7. How to avoid 401k nightmares. Now that we've covered the common pitfalls, let's talk about how to avoid them and maximize your 401k benefits. Steps to take. Understand your plan. Read the fine print and know what fees you're paying. Maximize your match. Contribute at least enough to get the full employer match. Choose the right investments. Opt for low-cost index funds or target date funds. Diversify your savings. Don't rely solely on your 401k. Explore other accounts. Plan for taxes. Work with a financial advisor to minimize your tax burden in retirement.